Hi there. Good morning. My name is Victor Aluyi, and I'm the head of investment strategy at Sankore Global Investments. And this is your weekly financial markets roundup. We start off in the US, where equities sold up sharply on Friday, sending tech stocks to their biggest weekly loss in about 17 months. The S&P dropped for the third straight week, notching its worst weekly performance since March of 2023. It also closed 5% below, its 52-week high that it had attained at the end of last month. For the week, the Nasdaq lost 5.5%. The S&P was down more than 3%, while the Dow eked out a 0.01% gain. The current negative sentiment really is still on the back of, the sticky path of inflation downwards and concerns about what that would certainly do to the possibilities or the prospects of a rate cut, this year. As a matter of fact, people are now beginning to price in the fact that we're not likely to see the first rate cuts up until about September of this year. And then a section of the market is actually entertaining the possibility that there would not be any rate cuts this year. If you add on top of that, the geopolitical tension that we saw somewhat escalate last week with Israel's retaliatory strike on Iran, that created, the perfect mix really for very, very strong negative market sentiments. All of these geopolitics basically serve to battle nerves in the markets. Going into this week, really, earnings will certainly continue, but we also have, some major economic data that will come out this week. GDP numbers would come out this week on Thursday, and we expect to see PCE data as well. That is the Fed's preferred gauge for inflation. We also expect to see that come out on Thursday as well. But I think that the market is likely to focus more really on earnings. Of course, in the absence of any major geopolitical flare-up, I think that earnings would largely determine market direction for this week. So far, about 14% of S&P companies have reported, and about 74% of those companies have beat estimates. This is lower than the 77% 5-year average that we have seen, really. Also, this week, we expect about a fifth of S&P 500 companies to actually release their earnings. Heavyweights like Microsoft, Tesla, Meta, Alphabet are set to release their reports. So we think that, for market direction, really for the remainder of the week, the economic data that we are expecting and also earnings would largely determine how the market behaves for the remainder of this week. Now, on global growth, the IMF concluded its spring meetings in Washington, D.C. last week, where it basically revised upwards, the global growth forecast for 2024, basically citing a much more resilient global economy, even in the face of tighter monetary policy. It raised global growth to a target of 3.2% from a previous target of about 3%. So it expects the global economy to grow 3.2% this year. It projects a slight acceleration for advanced economies with a 1.7% forecast for 2024, up from 1.6% that we saw in 2023. It expects growth in emerging and developing economies to sort of slow to about 4.2% this year from 4.3% that we saw last year. It also expects global inflation to decline steadily from the 6.8% that we saw last year to 5.9% this year and 4.5% in 2025. Also, last week, we saw, GDP data, Q1 GDP data for China. We basically saw the economy grow by about 5.3% year on year, essentially beating expectations and also growing faster than the 5.2% that we had seen in Q4 of 2023. This growth was, driven in part by external demand as export volumes grew 14% year on year. Industrial output for March was also up 4.5% year on year, nevertheless lower than the 6% expectation. Retail sales also grew at 3.1%, lower than the 4.6% that the market had expected, while inflation in major cities kind of came in lower. However, the real estate sector continues to show weakness. Property investment fell 9.5% year on year. Over here in Nigeria, in the fixed income market, illiquidity was the major driver for market sentiment last week. Most players essentially look to sell short-term securities to fund their bond auction winnings, as there was a bond auction last week. In all, treasury bill markets yields closed, higher as the market liquidity remained really, really tight. The bond market started on a relatively quiet note. I mean, participants were basically focused on the outcome of the bond auction. And in the aftermath of the auction, market sentiment was bullish as, all of the unfilled and unmet bids basically flowed into the secondary market. However, following, hotter than expected inflation that we saw last week at 33.2%, there was a bit of uncertainty, which saw, the bid offer spreads widen. In all, bond yields declined by about 23 basis points last week. For this week, there's a PMA auction that is happening on Wednesday. The market will certainly be looking for the outcome of that auction to get near-term direction. Over the last 3 auctions, we've seen the DMO consistently drop the rates. It remains to be seen if that trend will continue and, further entrenching the fact that they are essentially done or have reached the peak of rates that they are willing to go. So we'll keep an eye out for the outcome of that auction, as that would have very, very strong influence on how the market is going to behave for the remainder of the week. That's pretty much, our market roundup for last week and also our expectations going into this week. Do have a very productive week. Thank you very much.